I want to finish up long-term capital management. A lot of lessons in this one. Some of them are repeats from stuff we talked about earlier. So this was a firm, very quantitative, very much kind of the AI world we're probably going into, where everything is statistics. There's no humans involved. Assuming everything is risk and not uncertainty. Markets are somewhat random. They don't go in cycles. They don't go in a wave. Correlations tend to go to one in prices. It's part of that answer on the credit question is, yeah, corporate bonds are great, but in 2008, they were terrible. In other years, they can be terrible. They don't provide the diversification that treasuries do, because in a crisis, treasuries rallied, everything else sells off except for 2022 when the crisis and inflation. Liquidity is not an issue until it is when everybody's selling what you have at the same time. So liquidity, liquidity is one of the most difficult things to manage because it comes out of nowhere, and when it happens, it's just there's no way to get around it. You just have to survive. And then when you combine liquidity with leverage, whether leverage is debt or leverage is derivatives, it becomes a major disaster, because you can't get out of things cheaply. It's going to cost you a fortune. And then you're relying on models that haven't been, they're trying to apply them into a whole new market that, you assume all markets work the same, but, Russia is a brand new country. Who knows how it's going to react? And so how predictable all these markets versus what humans actually do. And then, we got down here. I'm gonna go back a couple. The machine will actually work. I don't know where I am. Where did I go? Okay. All right. So you get into some markets that are slightly different, but remember what Doug Hubbard said: a slight difference isn't a big deal until you get to the details, and then suddenly a slight difference, it's a completely different world, and everything is shocking. Scholes himself brought this up. They had a big position in Norwegian kroner. It said you should have stuck with what you knew, where your models were built for fixed income. They weren't built for these other assets. And yeah, Wall Street, it is shocking. You're going to discover Wall Street's not nearly as sophisticated as they like for us to think they are. Taylor talked a lot about this. Why bankers wear these dark suits so they look more conservative than they really are. There's a lot of uncertainty. We're seeing that again this year, where people are like, wow, I never saw that coming. It's like, yeah, but it happens every 5 to 10 years. Why didn't you see that coming? It's pretty common. So did the Fed act correctly? So the Fed got beat up on this thing, but they didn't use any tax dollars. All they did was use their influence. I don't know what happened with JP Morgan. It seemed like what they paid seemed awfully expensive, but I'm not sure exactly what they got. I didn't read the details. Well, they, spend 10 billion for a firm that's worth, whose market cap is 300. So they obviously must have offloaded some of those liabilities. Did JP Morgan want that bank, or was this them trying to step in, multi-trillion-dollar bank bailing out a $10 billion problem? I don't know. They got their CEO a lot of news coverage. When do these things happen? After a long period of calmness. So 2017 and years around there, where we had some really low volatilities. Y'all didn't notice it in your paper one, that the classes, the last year and the year before, it was just amazing how smooth that bar was. It was like nothing's happening. The world is so calm. And that usually is when something really horrible is going to happen, because people get so complacent and they tend to leverage up, right? Because Taylor talks about that. When things are nice and calm, we then start leveraging up in order to turn that nickel into a dime, the dime into 20 cents. And it works, and we just keep doing it. And then when it doesn't work, it unravels pretty badly. So this particular Lowenstein, he thought the Fed should have stayed out. let the markets lose, let them learn from their mistakes. Whether that's true or not. But again, I had lunch with the guy he's talking about. I didn't bring up Lowenstein, but Peter Fisher was very, very, very proud of what they accomplished. I did ask him about long-term capital management, definitely. And he didn't mind me asking that. That was kind of like his thing. So would have been interesting to see those two debate. The problem with this quote is I have another quote, and there's a secret behind it, and I don't remember what the secret is. So it's like a really ironical quote. If I just knew what the irony was, but I can't find my source. I used to have it on the slide, but then it kind of ruined the irony of it. And so I took it off the slide and I forgot to write down what it was from. But authors concluded that the hedge fund industry has been dramatically underestimating the correlation of its returns to the overall market. It's not this quote, it's a later one, but so this is what, 3 years later? 98 is when they went under. So 3 years later, hedge funds are dramatically underestimating the correlation of its return to overall stock market and thus remarkably overestimating the value of these funds. Hedge funds as a class have never been more popular or more avidly sold at a panacea for ills. 3 years after long-term capital goes under, hedge funds are back into the game. All right, so I don't know where that quote is. I might have taken it out because I don't know where it was, but it was a really, really great quote if I knew what it was for. So life is a trap for logicians because it's almost reasonable, but not quite. It's usually sensible, but occasionally otherwise. It looks just a little more mathematical and regular than it really is. Its exactitude is obvious, but its inexactitude is hidden. That sounds like Taleb. That's, coming out of the book. And then Mark Twain, history rhymes, it doesn't repeat. You can't just assume history is going to repeat itself. I'm not even sure history rhymes anymore because the world is so different today because of what's going on with globalization, with everything integrated. When was the last time China was the largest economy in the world? Like 580 or something. China's the largest, so we got a communist-run country that's the largest in the world. When's the last time India was the largest populated country in the world? That's never happened. And India is right next door to China. That's a pretty hot spot right there. Taiwan's just a little south. So do you think in the next 10 years something incredibly unbelievable is going to happen that no one's thinking about right now? That's kind of royal markets. Probably I would think so. We made it from like 2008 through 2019 with that much happening. Pretty calm, pretty tame. And then the pandemic happened. So I don't know, in your lifetimes, so what was my lifetimes? I had October 87 crash, but I was an accountant, so I didn't care. The 98 kind of almost crashed, but then the 2000, 2001, obviously 2000, that whole period is pretty bad. 2008 was really the biggest part of my career. And I was head of equities in 2008. So, but it ended up being my best year ever. But yeah, that was a horrible year. It wasn't fun being in finance in 2008. I didn't enjoy going to work. Fortunately, I didn't have a dog to kick, but you were really, you came home, the tension when you came home. And I know my peers, when they come home and it's like, yeah, my spouse, she don't want to talk to me. I'm like, she's just telling me I'm a really mean person. And they admit we're terrible people. And it was all of them. It was amazing. It wasn't equity guys, it was equity, it was fixed income. It was every single person was just under this incredible stress. And it wasn't for a few days, it was for several months. So will we have another 2008? I don't know. I'm not going to have another 2008 because I don't care. I'm independently wealthy. I'm pretty conservative. But you guys are going to have that. So how are you going to handle that when it happens? How are you going to take, and can you prepare now for it? It's kind of tough to do. It kind of gets back to the debate Taleb was having with Kahneman. Kahneman saying, hey, you can take those activities because you can underperform and be mediocre for a long time because you're so wealthy. Most people can't do that. Most people can't run these option portfolios and, make 8% returns. Everybody else is making 12 and 13. They can't do it. So, what are you going to do? You really can't do that. Your career is not going to allow you. So it'll be interesting. Y'all can let me know what your 2008 is going to be. We haven't really had a 2008 since then. I don't think 2020 and the pandemic, because the markets came back so fast. Is inflation now? It's bad, but it's not horrible. It's not the 1970s. And y'all know the stock markets in the early 70s. That was pretty horrendous. So you had 2 really bad years. So inflation could be the next one, and it might not be next year. It might be 20 years into. When do you want it to happen in your career? You want to be like right away, or when you're running billions of dollars of assets? Which do you prefer? What you really need to happen if you want to be the next Warren Buffett is you want to be really, really, really lucky early in your career, because then they think you're a genius and you get promoted. So, and that is a lot of the people that are famous. A lot of time it's just they were really lucky early in their career, and it just took them off. So I think there's a good chance Warren Buffett could be much poorer than he is today, just with one day where he just missed the elevator. All right. Oh, here it is. This is the quote. I did leave it in. This is such a great quote. I wish to know what it was for. It may be sufficient to note that a big ego is the one quality not recommended for people dealing in financial markets. Traders burdened with too much ego upon taking a loss tend to blame the market for the wrong turning, and sometimes they increase an unpromising position. If you knew who said that and when they said it, you'd be amazed. And I have no idea who it is and what they said it, but it's really amazing. I even say who said this, and I don't know. I should Google that, right? I could probably find it somewhere, but it was amazing. But I took it off because I didn't want to give away the secret. But anyway, all right. So there's your last case study. Let me finish up. Any comments on long-term capital management? Is it something you even heard of? It's probably been so many years now, no one even talks about it anymore. Hedge funds today, they've been pretty quiet. They haven't been performing nearly well enough to justify the big money that was going into them. So they've been a little bit kind of underappreciated versus their history. It's a great concept, but they're so expensive and they're all competing with each other. It's kind of hard to say for sure that they're really adding value. They're certainly making a lot of money for their employees, but are they adding value? That I'm not really sure. All right, let me give you some final kind of my keys to risk management. We talked about this earlier. Good risk management is not something you do on the fly. These contracts, y'all saw the swap contract. If you're going to do futures, swaps, options, you've got to get it set up in advance with all the parties, and sometimes it can be four parties or more. Get all the contracts done and then test it. That's what I learned with Northern Trust. When we tested it, we discovered they couldn't do the trade. No one ever asked the back office if they could do the trade. The marketing people just kept saying they could do it. So we had actually testing. And then we found out this was not going to work. It really messed things up quite dramatically. So beg your boss. Don't tell your boss, hey, I want to do this right now. Tell your boss, hey, there's going to come a time we're going to want to do this. We need to get this set up now. I'll do all the legwork. It's a great excuse for you to go meet a lot of people. The wonderful thing about being entry level is people don't know you're entry level. And so when you call, you're representing your firm, they don't know. That's why the head of Princeton's stats department kept calling me. He thought I was the decision maker. He didn't know I was a peon. So he was calling me all the time. And I wasn't going to tell him. I wasn't lying to him. I was like, oh yeah, I'm in line for CEO of the company. So, I probably had influence because I could, kind of talk my boss into it. But yeah, when you pick up the phone and talk, and I would call, here's a trick. Part of this one, there's a lot of free consulting out there. There's people who want your money that will give you all kinds of free education. I wouldn't lie to them and pretend like you're going to give them money. But I got a lot of free education from people where there was a chance they could get my money. I mean, it might have been 1% chance, but now Goldman was the one exception. Goldman talks to you once, they talks to you twice, and then they don't waste any more time on you. But that wasn't true for anybody else. JP Morgan, Deutsche Bank, any other bank. You keep calling them, they want your business, they'll give you everything. And boy, I learned so much doing that. And this helps you with that. Tell your boss, hey, I want to set up this infrastructure. Now you have an excuse to call the most sophisticated people at JP Morgan and Morgan Stanley and Goldman Sachs. And your business is actually thinking about doing this. So you volunteer, let me set up the infrastructure, let me call these banks. They will talk to you because you're the one that's kind of their inroad to it. But get these things set up, do it early. If you're hedging, don't hedge and forget it. I told you that with the pension plan, our hedge blew up in our favor, so we needed to make a trade. You saw that with MG, that they needed to really pay attention. So just because you're hedging, remember that basis risk, you got to monitor the hedges every day. Sometimes what that means is it's going to mess up and you're going to just have to take losses and get out. Sometimes it means you get these unexpected benefits and you need to capture those. That's why I remember, I told y'all how irritated I was with the guys who took my place. And they say, we don't need to do anything because we're hedging. It's all paper gains. That's like, it's paper gains unless you sell. So you need to make a decision. So you can't be complacent. They were kind of going through the motions of their jobs. Like, no, you got to make it. You're paid to make decisions. This one, I think I said maybe too many times, but I really, really believe it. If you're going to understand risk, you got to go to the extremes. 2008 is not the extreme. So take 2008 times another 20%. Go the extremes. We really haven't seen it. We have seen some. I mean, Japan's market dropping 80-something% and staying down for a good decade. That would be pretty devastating in the United States if that happened. We've seen interest rates get up to 8%, or if it's 4.5%. Get inflation get up to 8%. What if the 10-year treasury goes above 10%? What does come apart? What does start unwinding? Oil prices, all these kind of things. We have some history where the extremes, it's not just that oil prices jump double or drop in half, but they do it so fast these last few years. It's really been pretty amazing. I think that's what the pandemic did, is we saw, I mean, y'all remember, was it 2020 when oil price futures actually went negative? People would actually pay you to take oil from them because there's no place to store it, some really unusual things. So the extremes, we're seeing extremes that we couldn't imagine in 2008 and 2020. Always think in a portfolio context. Don't view risk individually in isolation. Always think in the context. That's what we learned at USA when we managed the bank and the life insurance company. It's like, my word, this amazing how these two entities so perfectly offset each other in a really, really amazing ways. We don't really need to waste money hedging. They're hedging each other. This is something I got from Dr. Mulvey. I don't know if, boy, I think his name is John Mulvey. Is he coming up? Princeton. See if he's still alive. Yeah, there he is. But that's what he looked like when I knew him. So he doesn't look like that anymore. Large scale expert. This is my discussion I had with him. I was running an optimization model and I was struggling so much with it. He was helping me out. He kept calling me. And he finally just said, forget optimization, just seek improvement, just get better and then do the whole thing again. So really, really good. But he had some amazing articles. I still have them. I'd share them with you, except for I read them while I was on the treadmill. So my underlines are like all over the place. I should have made a copy before I read them, and they're all sweaty too. But great articles. But I don't know if he has his articles online anywhere. Does he publish anywhere? Probably. operations research and financial engineering, research, current research, publications, maybe this where books, publications. Yeah, some of these are really good. I don't know which ones. So obviously he writes a lot. Maybe I can find, and none of these are linked, so I wouldn't be able to get them, but that was his big thing, and I learned a lot talking to him, was this portfolio context of risk. That you need to view everything in the context of how things fit together and move together. He called it integrated risk management. And I stole a lot of his ideas at USAA. How do we look at this company combined? And so when our CEO got really worried about rates rising and he started moving everything short duration, I had to go to him and say, hey, we got this pension plan that is so levered to interest rates that when interest rates fall, it's going to lose us a lot of money. So you're protected from rates rising, but we have a huge exposure to rate falling, and we don't have that protection anymore because you're shortening our duration. We don't have anything that's going to bump if rates fall, but we certainly have something that sells off. So we had to view it in that, and the problem was the models I was showing them didn't have the pension plan in it yet. So we had to add that in so he could see, oh, wow, yeah, I'm actually making us more exposed to interest rates than before. So don't view risk individually in isolation. When managing risk, be willing to be unconventional, because we know the traditional approach keeps failing every decade or so. Be willing to be alone. This one I agree with, but I don't think your boss is going to let you do that one. Why? Because what was that fourth risk? Career risk. It's really dangerous not to be like the crowd, because that's when you get sued, and that's the big downside with being in finance. And then don't make risk management decisions where the biggest thing you're trying to do is protect the ego. Let the ego go and just take the hits. And then one other area that I really love thinking about is this idea of brutal honesty. Seek the truth, not confirmation. I think this might be the single most important aspect of risk management. So I had my list. To whom do you listen to? All right. So how do you find truth? So I had my list, and then I read a book that some of y'all will probably hate, depending where you are in the climate change debate. But I don't know enough about climate change to know if he was right or wrong on it. But it's a really good book. I really enjoyed it. But he's a philosopher. Y'all probably seen him in the news. He's been beat up. He got beat up by someone in Congress the other day. Like, you're a philosopher, what do you know about energy? But what I like what he said about how do you know you can listen to someone? What is someone who's giving you good information versus biased information? And these are the points he made. They're different than mine. So in the notes I had my points, but I actually liked his points. His overlaps with mine. So he says the first thing they do is they present evidence and not authority. So their goal is to show you their evidence. I saw a TED Talk once. Oh, this person irritated me. It was on climate change, and I want to know the facts. What are the facts on climate change? Well, she started off bad-mouthing George Bush. It's like, okay, that has nothing to do with climate change. But her point was how stupid he was to go into Iraq. And it's like, okay, that's fine. And then the whole rest of her presentation was, we got to do climate change because even if there's only a 0.1% chance it destroys the Earth, we got to act. I'm thinking, wasn't that George Bush's argument for going to Iraq? Even if there's a 0.1 chance he has a war. But I was like, her whole thing didn't make sense. But her entire presentation was how important she was. It's like, I don't care what data do you have. And she kept talking about, her positions, or it's like, I don't care. What evidence do you have? So present evidence. People who are, have really good stuff to tell you, they can't wait to give you the evidence. That's their most eager thing they want to do. The evidence is clearly stated and precise. They give you the evidence exactly. They don't round it up. I know people who round things up to the nearest whatever number they need, kind of rounding up. You can't trust. What is the CDC says 120% of the U.S. population is going to be obese by 2040. It's like, what is that? I did see one, someone says, current trends, 100% of Americans will be obese. It's like, I don't think that's going to be the case. I seriously doubt that. But why would the CDC say that? Because they get a lot more congressional dollars if there's a crisis, right? If you're an agency that gets congressional dollars, you need a crisis. So they got to make us all overweight and dying of all these diseases. So these people, the people I listen to, they're very precise in their data. They don't provide data that is exaggerated, rounded up. They clearly state, and this is probably maybe as equal as important as others, they clearly state what they're unaware of. They don't consider themselves all knowing. This is why I hate politics. I want a president who says, I'm running for president. Here's my philosophies. I can't give you my issues and my programs and policies because I don't know enough yet. I got to become president. I got to hear all debates. So I might raise taxes, but I might cut taxes. I might raise taxes on the rich. I might cut taxes on the rich. I don't know yet. The world's too complicated. I need to hear the experts. That's the kind of president I want. If that person like that get elected, probably not. But that's what I want, a president who says, you know what, I'm clueless, because everybody's clueless, but I'm going to sit and listen and we're going to figure this out. That to me makes sense. I do want to hear their philosophy. What's their philosophy of government, their philosophy of international, their philosophy of economies. I want to know their philosophy. Actually, what I'd love to see is every president should take the US Constitution and rewrite it the way they want it to be worded. Show me what you think it should say. You don't like the Second Amendment, rewrite it the way you think it should be. You don't like the First Amendment, rewrite it the way you want it. What are you going to do with the Commerce Clause? What are you going to do about foreign policy? I want you to rewrite. I want to hear their philosophy, but I don't want to hear their programs and policies because they're clueless. They don't until they get in. But that's not what we do. We hire people. We elect politicians that are all knowing. They address competing arguments. I love Milton Friedman because he does this. If you read his books, Milton Friedman will address the competing arguments. You would think Milton Friedman would hate Keynes, but he's very complimentary of Keynes. He talks about him very favorably. That's why I like Friedman over Krugman. Krugman just destroys anybody who disagrees with him. He can't help but call them idiots. It's like, I don't like that. If you can't show respect for the other side, it's, there's something kind of wrong with your arguments. I like The Economist. The Economist does, I think, a pretty decent job, not always, but a pretty decent job of at least acknowledging the other side of the debate, even on some really, really hot topics that they're way on this side of the argument. They'll still present the other side. I kind of like that. My friend doesn't like it. He calls them a communist rag, but they're very Keynesian. Yeah, they're kind of traditionalist economists, but they at least present the other side and discuss it. That's kind of nice to me. It's not CNN or Fox or they have ability to at least acknowledge the other side. I can't watch those TV shows where the announcer has someone disagrees with them on the show. He asks a question and they speak for what, 4 words before he interrupts them and starts screaming at them. It's like, can you let them? I've seen sometimes where they're making a pretty good argument. It's like, can you let them finish the argument? But no, and why is that? Why do they start screaming? Because what's the purpose of their show? It's to elevate the guy on the program, right? It's not to make arguments. So I don't listen to those kind of programs. They just irritate me. And they don't argue against ridiculous. I put the word ridiculous in there. Ridiculous straw men. I heard a philosopher, professor, he was arguing against my beliefs, my personal beliefs. And I listened to this. You know what? You're absolutely right. What you're saying is so ridiculous. No one in their right mind would believe that. But I don't believe what you just said. I believe. So it's kind of a ridiculous argument. So why don't you debate what I actually believe? That'd be more interesting to me. But no, he created a ridiculous straw man. But your goal has to be to seek the truth. So, I'm showing you here. I'm almost tempted to recommend this book, but he says the human brain is set up to believe we're omniscient. We're set up to believe we're absolutely sure about our beliefs. And I know that, boy, that hits me all the time. So I try my best when I see a book that I know I strongly disagree with, to go read it. It's painful to do that because there's sometimes you just like, I don't want to have to deal with it anymore. But he says we're set up to do that. We're set to be confident, 100% sure about stuff that we can't possibly be 100% sure about. I saw somewhere what it was like 60% of scientists believe in parallel universe in string theory, and it's like, what evidence do you have? I mean, it's like, why would there's so much stuff we're so uncertain about. I've seen some of the flat earthers that are 100% sure the earth is flat. And it's like, how could you really be that sure? It's like, I don't. But he's saying we're conditioned. It's almost impossible for us not to be 100% sure. So I know there's stuff I'm 100% sure about that there's no reason I should be. I should just list them all. So one question I like to ask is, what do you believe today that 5 years ago you absolutely were in the opposite side of it? How often do you change your strongest held beliefs? And it's not very often, is it? It's pretty rare. So as your goal is, have your strongest held belief, how many of them are true? In my case, I think I'm less than 1%. I think of all the stuff I'm 100% sure about, probably less than 1% are 100% sure. That's because I just don't think humans know that much. I think we're incredibly ignorant. So we should seek truth because we're making decisions with other people's money. We're making decisions with corporations. We have got to just admit our ignorance and listen. I don't know on this. Do y'all read on a regular basis? Maybe that, or listen to YouTubes. Have you read authors you hate and disagree with? So if you watch Fox News, start watching MSNBC and find some author that comes on that they're not screaming at, that they all love, and go read their books. Or if you watch MSNBC, go watch Fox. Most of them sit there talking what's right behind their head. The Visitor. Isn't like 20 other books on the shelf? I bought the last 4 books I think I got from a speaker. It's like, oh, they got a book, and I go buy their book. The book I'm reading right now is pretty amazing. Anyway, I don't think I got that. It was the same author, but it was I saw the book and then I saw another one that he wrote that looked more interesting, so I went and got that one. So read to have your mind changed. With that as your goal. Going with the goal that I want to believe something radically different after I read this than when I started reading it. Otherwise, you're wasting your time reading. Don't read to have your thoughts confirmed. All right, that's your ego, right? So don't read stuff you agree with, because what's that going to do to you? That's just going to confirm you even more, and then you're going to be more untractable. So, sorry, I kind of go soapbox last class, especially on this. And then the greatest risk of all is purpose, whether it's why you exist, why your corporation exists, what are you doing? So ask that question of all, and so I'll give you this book here. I was tempted to play some of this to you. How many of y'all know this book? Y'all read this? I probably shouldn't recommend. Y'all probably can't handle it. It's probably too much. I'm kind of saying that hopefully when you'll read it just to get me. So y'all heard of Toy Story, right? This is not War and Peace. This is like, you can read this in a couple of days. It's a novelette. I read this probably in my early 30s, so I'm probably giving this to you a decade too early. Boy, it's an impactful book. Tolstoy's a great writer. I have read quite a bit of his stuff. I have read War and Peace. It's my least favorite of his, but he has a way of getting right to the central theme of what we should be thinking about. Anna Karenina, and I've read that one. Great writer. But in this book, what he does is he has a story about this guy Ivan Ilyich. You got to be careful. I was reading one review, and the reviewer is a YouTube review. I read this recently with a bunch of friends. We were having an online discussion about it. And one review says, I really recommend this book. It is so encouraging and uplifting. I was like, wait, what was he reading? And I was reading through the synopsis of the story, and it's like, well, it's the wrong book. And I think what he did is he watched a movie based on this book that had been cleaned up. And that's what he was reviewing. Because if you read this book and you come out happy and encouraged, you read the wrong book, right? This is not an uplifting book, but it's very sobering. And I think we got to be sobered sometime. But this guy, Ivan Ilyich, he's in Russia before the Bolshevik Revolution. Tolstoy died before Lenin, so would have been interesting why he would have written post Lenin, don't you think? That'd be interesting. But he does everything he's supposed to do. He goes to college, he gets his undergraduate finance degree. He's actually a legal guy. He gets the right job, he's moving up, he's getting all the promotions. Finally gets the job he wants. He goes, buys the house, he's fixing up the house. His wife and kids are going to come join him. While he's fixing up the house, he has this kind of fall off the ladder, kind of hits his side. No big deal, nothing to worry about. I'm giving y'all the story away, but you can still read it because Tolstoy's, it's his writing, it's not the story. The story is really depressing. And then the pain starts getting worse. It's kind of dull, and then it gets a lot worse, and then it gets a whole lot worse. Then he's bedridden, and he starts discovering, first of all, how dishonest everyone around him is. His wife is horrible in this book. His daughter's horrible in his book. His son's pretty decent, so he does have a problem with the women in his life. I don't mean Ivan Ilyich, I mean Tolstoy, if you read his life. But anyway, just everyone's fake. The doctors are all fake. That all doctors are all telling him, hey, here's the prescription, this will make you well. The doctors all know they have no clue what they're talking about. They're making stuff up. Everybody's really, really nice to him, and he just discovered how fake everything is. It's a pretty depressing book until finally one guy comes in, this guy named I forget his Jiraman, I forget his name, but his kind of caretaker. It's the only, you're almost in tears when this guy comes in because it's the only kind of decent person. But what does this guy do? He comes in and he's honest with Ivan. He tells the truth. He says, hey, you're dying. Let's make your life as pleasant as we can till the end. You're like finally a decent person in this book. Because there's so much dishonest. And that's something really strong you see in Tolstoy. He just hates deception. And that's kind of my thing. There's one of his short stories where Russia's fighting France in the war, and they have a ceasefire because of Christmas. And he's thinking how ridiculous, here we have French Catholics and Russian Orthodox Christians all celebrating Christmas together, and then the holiday's over and they start shooting each other. And he's like, isn't this? And at the very end, he says the hero of this story is truth. So he's all about truth, and that's what Ivan Ilyich is facing. No one's being honest with him; everybody's lying to him. But the most painful part of the book, and I think what was eye-opening to me, really changed the way I thought about my career, was when you get to chapter 9. Chapter 9 is so dreadfully painful. So I thought the last class I would just really depress you guys. But chapter 9, he has this big debate with his soul. And he tells his soul, I want things different. And his soul says, what do you want? He says, I want things back before I fell. And his soul says, well, how was that? And he starts thinking, he goes, oh, that was pretty pathetic. I was going through the motions of life, nothing mattered, everything. And you're like reading the book there and you're like, what a depressing book. But what Tolstoy is trying to get people to do is wake up, think about what you're doing with your life, make it matter. And it's pretty sobering. The very end, he dies and no one gets better except for this one servant, although his son kind of decent in the end. I do recommend it. I wish I had read it when I was 22, but my life worked out really, really well. Maybe because I read it at 30. But figuring out the purpose, what you're after in life, I would really encourage, think through who's surrounded in your life, what you're trying to achieve. I'm not going to get too philosophical, although I've gotten too much. But the biggest risk is you get to my age and you're like, what did it all matter? What did you do? You don't want to have your granddaughter on your lap at 70 and say, yeah, I ran a mutual fund. We grossly overcharged our customers. We made a lot of money doing it. It wasn't a very good fund. They didn't make much money. That's not the story you want, right? At the end of your life. So you're in a career that is extremely important. It makes a lot of decisions. It impacts other people quite dramatically, but it also makes a lot of money doing really horrible things. And so, as I tell students, your first job, you kind of stuck with it. You got to take the job. But I think after your first job, you get experience. You got to start thinking, whom do you want to be associated with? And it may not be the money. So $500,000 is pretty good. It doesn't have to be $850,000. And you can accomplish a lot making $500,000 a year that you can make $850. My goal early in my life was, I kind of got it right, is avoid assets at all costs, avoid debt at all costs, so that if I did want to make a major change, I should just get up and leave. And I've had students 25 years old that have big mortgages, big debts, and the great new job comes along and they can't take it because they need the 90,000. They can't afford to live on the 50,000, and they've just destroyed everything. And now they're stuck kind of like Yvonne, where he can't live his life because he's invested too much in the shallowness of things. So I don't know what it is for you, but I would start thinking about it now, because I don't know how you tell you this, but you only get one shot. You don't get to go at 60 and say, I'm going to do that all over again. You only get one shot at this. And the next 3 years of your life are going to determine 90-something% of that shot. Don't you agree? So you got to make it. So I would say, if I were you, to me, it worked out perfectly for me because I was just purely lucky. And you don't want to rely on luck. So you got to think more about it. So I would say after 2 or 3 years, if you're not where you want to be, make a radical change. Jump ship, go somewhere else. Don't be scared of radically changing where you are and going somewhere else and trying something radically different. Because you don't want to show up, especially at 30, 35, 40, mid-career, or if your second career, 5-10 years into that second career, and you're not in the right spots. You got to make changes, be willing to change. As my advice is always, if you get an opportunity to change, if the only reason you're not doing it is because you're scared, then you're really messing up. Fear is usually the best indicator you should do something. If you're really scared of it, just do it and don't even look back, and you'll be happy. So go for it. But it's brutal. It is really brutal honesty. I was reading Kierkegaard. He's the big existentialist. I can never say that word. And a lady at my church says, "Hey, don't read him. He's an existentialist." And I'm thinking, I think I am too. You only get one shot at life. You better do it well. You better think about it brutally, honestly, and get into it. You guys are really smart. You're going to be really successful, but success is also related to purpose, doing things that matter. So yeah, I retired at 46 so I can teach because I love teaching. Whether or not that's going to be useful or not, all depends on if y'all do anything. Or y'all might do something that had no influence on you, and so then it's still a waste. I got to figure that out when I leave UTSA and say, wow, what a waste of 20 years. I hope it wasn't, because I have had some students that have done extremely well. But so I'm hoping this is purposeful, but it feels like it is to me. But I'm committed. I've invested in this is what I'm doing, and I believe in it. So hopefully when you get to my age, you're going to be like, wow, because my life feels like really perfect right now. My fear is 20 years from now, when the dementia comes in and my brothers are like, you're on your own, they're not gonna, so I got that ahead of me. But right now it's perfect. I love it. I set it up just right. How did I set it up just right? Pure random luck. I don't like assets. I don't like cars. I don't like houses. I don't like debt. So I never messed with that stuff. So I never had to worry with it. And what is an asset? It's forced adulting. Do you want to do forced adulting, or would you rather adulting be optional? What does a 3,000 square foot house do for you that a 2,000 square foot house doesn't do for you? It's 50% more cleaning. It's a lot more maintenance. What does a $70,000 car do for you that a $20,000 car doesn't do for you? Get more tickets, spend more gas. So I don't like assets. I don't like debts. So I focus on experience, travel, impacting, trying to get involved in people's lives. So you can do it. You're in a career that can do it. You're in an extremely important career. It's the reason I switched from accounting to finance. Finance is far more impactful, far more important to the corporation, far more damaging to the corporation, makes much bigger mistakes, has much bigger triumphs, much more stressful. But yeah, I encourage you, think carefully. I am your professor for life, so you can call me at any time 20 years from now. I don't know what I'll tell you, but in the next 10 years, I can probably give you some decent input. So you need a sounding board, don't you? Remember what Annie Duke said, you need to have that truth. And me with my Asperger's, I'm always honest. So you may be crying after talking to me, but if you want brutal honesty, you'll get it from me. I can assure you that. If you've ever gotten a compliment from me, you should take it to the bank, because I don't compliment people. It's they deserve it, from my opinion. So you feel free to call me anytime and I'll give you my impact. I'm always going to tell you, hey, are you scared of it? Then take it. I mean, that's always going to be my advice. Take the scariest thing. Don't ever settle for second best because you're scared if you can do something. But feel free to call me. I don't know, my phone number will probably be the same the next 10, 20 years. Let me know how you do it. Most of y'all are graduating this semester, aren't you? I think. Anyone not? So Waylon, yeah, you took me in Lance. Yeah, it's a couple of y'all are seeing me next semester. Some of you, like Joshua, taking like 3 or 4 classes. Maybe I don't know how you survived that. So I do want y'all to be successful. I do want y'all to change the world. I think finance has some serious ethical issues. And I'm hoping y'all are the ones that change it for the better and fix it, and don't just kind of, hey, well, they're paying me a lot of money to do awful things. Why not just keep doing that? I hope you're not going to be in that crowd and that you're a radical thing, change things. So, all right, that's it for me for the semester. We have the exam on Thursday. So you got 2 math questions, and then you have essay questions. Get the math questions out of the way on Thursday. If you're having trouble with the essays, then call me. The best time to call me the next week and a half is when's the essays due? Monday night. So so Friday, Saturday, Sunday, best time is in the morning, because I'm going to be grading everything in the afternoons. And you can call me then, but I'm better on the bike if you call me then. So feel free to call me if you have questions. If you send me your essay to review it, it's going to be a really fast review. I'm grading like 500 and something things in the next few days. So I've got to average like 50 items a day just to survive. So I can't grade your paper twice. So the best thing to do if you want feedback is not to send me your paper, but to send me a very specific question. Like, I want to address this and highlight it, and just at that I can respond very quickly. So, all right, so I'll stop there. See, I let you out early, the last class. So now what I want to do is walk through the essays. I didn't do this in the last class, so this is a tag to the last class. But a few students have been asking about how in-depth I want them, and I do want very detailed. There's only 2 questions to answer in the essay, so I do want some substantive, intense questions, answers to the questions. So the first one is on risk. So you got to pick one of the main ones: interest rate, price, and credit. Interest rate risk, if you go back to the notes on that, the definition is pretty straightforward. Measurement, the main measurement that we talked about was duration of net worth, and the primary mitigation tool we used was balance sheet immunization. What I'd recommend you do on any one of these risks is go back to the notes and read them, and then read them again in small sections, and then write your answer off the top of your head. Don't do any cut and paste. Cut and paste is real difficult for me. I count off a lot if I'm just reading my own words. Some students like to cut and paste and then make minor wording changes, and that's not good enough. You need to really put it into your own words. The best way to put it into your own words is to have it in your own words. No cutting and pasting at all. So I strongly recommend you read the definition, read it again, go back to the class, so pick which ones you're going to do. Go back to the classes, go out on YouTube, back to the classes that we did that, listen to the class, read the notes, and then write your answer off top of your head without referencing back. Then you can go back and reference, re-listen, and edit the answer, but have it come off the top of your head. So what is interest rate risk? It's the risk that interest rates change and assets and liabilities move in different ways, such that you lose net worth. Okay, well, how do we measure that? Well, we measure that using duration of net worth. Well, what is that? Well, you have a formula.
We had the problems that we worked. You're looking at the duration of assets, the duration of liabilities. So you can certainly work through that problem. Value at risk is another way you can calculate this. I don't remember if we talked too much about that. So our main focus was on duration and net worth. And then how do you mitigate it with balance sheet immunization? Well, what is that? That is when you try to get your duration and net worth within acceptable levels. One of the mitigation is the board limits that we talked about. So the board limits, you're doing stress testing, and that's your measurement is the stress test. And then the mitigation is the board limits. And then how do you get back within the board limits? That's the balance sheet immunization. So you're essentially going through everything we talked about there and putting that into your own words. Price risk is the risk that a price of something falls or the value of a liability rises, such that you lose net worth. Interest rate risk was a special case of price risk. So really interest rate risk is part of price risk, but just special case because interest rates are so important to banks, insurance companies, and pension plans. So price risk, that's how you measure it, that's how you define it. How do you measure it? We talked a lot about value at risk. So you want to make a good discussion on that. I would, in your discussion of price risk in your definition, I would distinguish between parametric, historical, and stochastic value at risk. And then how do you mitigate it? A lot of this you can get from your paper 1, but risk limits using derivatives to control some of the risk if the value at risk is too high. But then the main one we talked about was correlation. We spent a lot of time on that. Now, that's one of the essay questions from that you're doing as part of the second part. So that's really, correlation as a tool is a big part of this answer here. So if you're doing 2A as your essay, then price risk might be the one you want to cover under number 1. And then under credit risk, the risk of a firm not meeting its commitments to pay you back. We make the distinction in class that I think you should make in this answer between default risk and spread risk. Default risk is that someone actually misses a payment. The spread risk is the risk that the person who owes you money becomes more risky, more dangerous. Their credit quality declines. They may not have missed a payment, but the credit spreads have gapped out such that you're losing money on their bonds. So those are the kind of things I'm looking for, pretty intense. So go back to the class notes, listen to the lectures, think about what you talked about in paper 1. You might go back to paper 1. You can certainly, I don't count off for plagiarism if you plagiarize what you did in paper 1. So you can certainly pull stuff from paper 1 because that was a big part of your paper 1. And then number 2 is pick the second part is pick 2 of these other ones: liquidity risk, basis risk, model risk. I'm not looking for as intense of answers there or discussions, but we did talk about them quite a bit in class. So I would definitely on those go back to the class notes, go back to the lectures, listen to it, and then put it into your own words. Some of them are easier than others, but that may make it more difficult to write a lot because we didn't talk about them as much, but we did go through each one of these. Liquidity risk might be the easier one to do because not only did we talk about it in class, but you also wrote about it in your paper 1. So again, you can pull some of your paper 1 into the answer if you like, and there's no plagiarism on that. So that's question 1. Should be a pretty intense paper. I don't see how you could do it in under 2.5 to the 4 or 5 pages. It's going to take quite a bit. It's a pretty intense answer. On the next ones, the first part of this first one on standard deviation and correlation, you have my entire blog there. So essentially this one is summarizing my entire blog. We also had the lecture, and you also have the PowerPoint from class. So that's one where you could read the blog, and as you read it, just stop and put it into your own words. Again, no cutting and pasting, or it's really going to hurt your grade. The case studies, you're going to pick 2 of those. What you need to do is give some background on the case. What did Orange County, who are they? Who is Robert Citron? What did he do? And then go through what did he do wrong? Lack of supervision, getting into things he didn't understand, not measuring all risks, no measurement of VAR, those kind of things. MG, it's a basis risk case. What went wrong? So describe the case, give the background, and then talk about what went wrong. You can do the airline industry. Go back and listen to that one. Michael did quite a bit there, but the main thing we're focused on there was the just managing the complexity of the operations, the scheduling, getting the planes, getting the workers to show up. What happens when he talked about what happened in January of this year, where airlines are just shut down for 3 hours because of some system break. How do you handle that risk? Come out of it. What did Southwest Air get wrong and causing their major blow up this year? So on each one of them, it's describe what happened and what were the lessons learned. On Tylenol and the airlines, the lessons learned, you're going to have to come up somewhat on your own by going through those cases. Orange County, MG, and long-term capital management, I have a list of the lessons learned for each one of those. So they may be a little bit easier to get into, but that's what you want to do. Don't give me just 1 or 2 sentences of what happened. Give me a good description of what happened in each one of these cases. And then the last one you have to choose from, if you're not going to do those first 2, is then pick 2 of these writers. Doug Hubbard and Daniel Kahneman, they were videos that you watched, so you'd have to go back to the video and put those into your own words. There are some class notes on each one of them as well. Annie Duke, there was an entire PowerPoint presentation, so it's just going through that, listening to class lecture and putting that into your own words. Taylor may be the easier of the 4 because the class notes is already broken into the sections. Again, don't cut and paste. Now you can certainly cut and copy and paste his quotes if you want to quote him, but then put into your own words what he means by those items. If you're not sure exactly what your answer, if it's meeting the standards, certainly feel free to give me a call. The best thing would be to give me a call and you could read some of your answer and I could let you know if you're on track. What I'm going to have a tough time doing this time of semester is students emailing me, wanting me to grade their paper before they submit it officially. That's just going to be tough. If you do that, I'll look at it really quickly and I won't tell you if it's an A, B, or C, but I will tell you if I notice that it's just way too skimpy. But I prefer you be much more specific. Maybe I don't mind you calling me because talking on the phone, especially in the mornings, that's not difficult. Having to reply by email is just very time consuming. In the mornings, I'm on a bike, so I can't grade any papers anyway, so it's a good time to catch me and talk about this. So I want really meaty, intense, full answers. So don't give me skimpy answers. Put some time. Each one of these essays should take you several hours to put together. So make sure it's a meaty, full answer. And be real careful with any kind of copying and pasting because that could really cost you a lot of points.